Got with us then A Bala, who is joining in to discuss his outlook on the markets, Managing Director and CEO at Aditya Birla Sun Life AMC. Thank you so much for taking time out and joining in on ET Now. Just let's begin by getting your outlook on where India stands at the current juncture, because despite all of the conjecture when it comes to the debt ceiling negotiations in the US, etc., it seems like India is in a sweet spot in comparison. Would you concur?
I think it looks like that it's in a better wicket, given the fact that on the macro side we are seeing a significant improvement and stability. One, starting from inflation is a lot more under control when it comes to the question of taking a decision on interest rate. Second, the current account deficits have improved quite significantly from deficit. Now the deficit is quite narrowed. There is a high probability that we may end up in a surplus during the year, and currency stability has also been a lot more better. And growth expectations, even the reiteration of growth, which could probably in the range of over 7% by the Reserve Bank of India Governor himself, I think goes to show that that I think overall things are a lot more under control. And lastly, the company's financial numbers, which has been reported for the March ending, most of the companies, almost about 50 to 60% of the companies have beaten the analyst expectations, which essentially means that reflecting the broader level structural change that we have been looking at driving seems to be paying in terms of delivering better performance. See, all in all, if I see compared to the global market, definitely India is in a better wicket. And on the contrary, the recent uncertainty that continues as far as the China market concerns, despite people turning bullish and going and putting a lot full of money, and they're not seeing the real immediate outcome that most of them would have expected. Also making people believe that India could be a good destination. A lot more predictability is much easier, and lot more stability. And that's why I see India in a better wicket compared to the global market.
Bala, the markets are no longer bombed out. They are no longer cheap. If earnings are expected to grow at 12 to 13% or 14 to 15% looking at the estimate, do you think that should be the maximum expected return from here for next 2-3 years?
I think return definitely could get muted given the fact that India has been outperforming the market for quite some time. Also, we must also note the point that the current juncture at 18,000 index, I think the Nifty is trading at about close to the last 10 years average. Not discounting any potential upside that could come in the both economic growth as we move towards the elections and then beyond, and also the corporate earnings can continue to be the major driver. Those are not getting discounted at this point of time, given the fact that that Indian market is outperformed for quite some time. But my own belief is as interest rate starts coming down the next year, and then the supported by good growth coming in, probably we should see some kind of premium valuation starts coming in, which probably we should see it coming in next year. But from the return expectation point of an equity, given the fact that earnings yield versus the bond yields, if even today, if you look at it, bond yields are much better. Therefore, it's not fair to expect substantially higher return in the equity as we have seen in the past. But anyway, the expectation should always be kept somewhere close to about nominal GDP plus 2 or 3%. And beyond that, whatever comes, it should be taken as a bonus for any investor in the market.
Bala, do you think large part of the rally in the fixed income market is also over because inflation has peaked out? Reserve Bank of India has hit a pause button. I mean, they're not going to cut rates now, which means that the fixed income rally is also over.
Fixed income rally, probably we can say that the longer end already started discounting two things. One, the current account stability, liquidity is getting better. The 2,000 rupees note to be submitted back to the banks before the September will improve the overall liquidity in the banking system. Therefore, demand for GSS will increase. The RBI post announcement of dividend, which was 2 times higher than what was budgeted in the numbers. All of them actually is going very well as far as the fiscal concern. And that's why I think the bond market in the longer run rallied. But as we start seeing a moderation on the inflation, and then globally with the interest rates cut, right now we are in a peak cycles, and we believe that incremental hike will not come. But as they start thinking about rate reduction, as if it happens in US, then followed by India, we will still see rally coming in the short end of the curve, which is basically if you take 1 year 7%, 2 years 7%, 3 years 7%, 10 years also 7%. The ideally speaking, the curve should be a little steep. That's why I believe that shorter on the curve will come down next year. Therefore, from investors' point of view, the dilemma would always be: should I play the fixed income market through the long duration, or should I play the fixed income market through the short durations, short to medium durations? We suggest the short to medium duration would be more ideal for investors to look at it, given the fact that yields are still high. Therefore, the carry in the portfolio is also a little better.
Bala, last time when we spoke, you said I'm examining the new Sebi proposals for mutual fund TR. It's been 3 days. I'm sure by now you must have done the numbers. What could be the impact for your AMC? What could be the impact for the industry? What could be the impact for everybody?
Of course, I'll currently refuse to, rather not talk about the impact on us. But otherwise, broadly, the proposal which has come in is clearly the one is TR reductions at the linked to the AMC level. Second is the combining STT and GST to the TR. All the things leading to a TR reduction on overall basis. Therefore, ideally speaking, on the basis of this math, that it will have an impact on the revenue. It will have an impact, of course, on the bottom line, which, of course, the market knows about it and everybody has been factoring in. But having said that, these are consultation papers. I'm sure in the best interest of the industry, which has been a bigger driver for the capital market growth, and we still have a long way to go. We will make the right representations. I'm sure Sebi's intention is to not hit anybody on the profitability. At the same time, they're also looking at the longer term orderly building of the next round of growth. So I'm sure a fair representation from the industry would also be heard by the regulators, and basis which we are quite hopeful some middle path will be taken, which will make it more neutral and not to have an impact irrespective of whatever the size of the industry. At the end of the day, the due respect has to be given for the people who have been building the business for some number of years and brought to where we are today. So all such the respects have to be given. At the same time, encourage more players to come in, given the fact representation is still large. So I'm sure fair representations would bring in some element of a middle path for the whole thing, Sam.
Bala, for investors, there's one concern which they always have after every 5 years. 6 months before a general election cycle, what could be the linear impact of it if the verdict is not what markets like? From an aggregate standpoint, this is a linear 5 to 10%, even 5 to 10% event. What should one do?
So I think one of the things that my own belief is remains permanent in our system of the last few years, and whatever the hope and optimism that we all had as a country, all along getting materialized. They have not gone in vain. They get materialized and continue to see the impact of that hope and optimism in the form of the real life change that we are seeing in the country as a whole. Therefore, from an investor's point of view, that faith, I think, has to be maintained, irrespective of whatever the outcome we would have seen in the recent election results and so on and so forth. At the end of the day, the real impact is the one which ultimately drive the economic growth, which in my own belief is, I think we have gone beyond what we have seen in the past. Therefore, I think from investors' point of view, the faith has to be kept, and also from a broader the future the point of view, the way every foundation stone is being built, I think we are only building it for the better future of the country, irrespective of whatever the political situation that we may see. I think building blocks are more in the name of building the Bharat as a whole to the next level. That's why I think everybody looking at fight in the economy, foot in the economy, all are coming from the fact that we are putting lots of building blocks actually to make it happen. Therefore, that's the fight I think one has to bring on the table rather than getting swayed by the short term, any outcome that would come. Of course, short term outcome can never determine actually the longer term future, which in my own belief is very bright, and one has to build that faith and confidence while making the investments and building their own portfolios.
All right, you got flashes coming from LIC that VNB margins will definitely improve in FY24. You got, I think Adani Group stocks have stopped falling, so Adani LIC should start rising. I mean, it's very simple. Whether we like it or we don't like it, the stock of LIC completely collapsed after this Adani Group of fiasco, which broke out in late Jan and early Feb, and that also coincided with the budget changes. So, all things put equal, valuations, underperformance, mark-to-market gains and Adani Group of stocks, things now for LIC for the second half of the year could really look better. So Bala, what could be the dark horse for 2023 and beyond? I mean, which is that one sector? Let's say for defense manufacturing 2 years ago, it was railways 6 months ago. What is that big bet at Birla AMC?
I think from our AMC point of view, clearly we have been keeping a close eye and continue to stay bullish as far as the banking financial sector is concerned, given the fact that across the economy. And second is we also see the silver lining, better silver lining as far as the automobile sector concerns. We continue to believe that auto ancillary will do well. And capital goods sectors, given the fact that the huge amount of investment both by the government as well as the private sector capex also beginning to pick up. We believe that segment will, I think, continue to be the driver. But I also see the breadth in the market widening, given the fact that the huge amount of benefit has gone into the mid-sized company in the country by way of low interest rate regime and the whole ecosystem getting more better. There are small size companies are getting the huge advantage at this point of time. And therefore, that also we should see widening of breadth in the market getting widened. Last but not least, we are also believing that the FMCG sectors have gone through a good amount of consolidation phase. And we also believe that with the general spending levels rising and the commodity prices somewhat remaining low, even select FMCG companies should also be performing better.
All right, Bala, good to have you on board as always. Thanks so much for joining in and sharing with us your outlook on the macros, the markets, as well as individual sectors.